Hello, everybody, and welcome to another episode of the Macrocast. I'm your host, Ylan. I'm Managing Director at Penta. My co-hosts are John Fagan and Brendan Walsh of Markets Policy Partners. How are we all doing today?
Yeah, fair to middling.
Sounds a little bit like inflation right now, right? Well, we've definitely been seeing a lot of economic data come out over the past week. The latest one was core PCE inflation, the Fed's preferred measure. That's down to 3.7% for the month of September compared to 3.9% for the previous month. Now, that's largely in line with expectations, the slowest pace since March 2021. So, guys, it feels like it's almost a certainty that the Fed is going to hold steady next week.
Yeah, that's definitely where futures markets have been basically assigning almost 0% odds to a November rate hike. And, and this is despite the fact that we've seen, and we'll talk a little bit more about this, persistent upside surprises, particularly in the most recent data, GDP, very notably the last non-farm payrolls, the last retail sales numbers, although all of these have nuances, particularly retail sales sort of underneath the surface that we can talk about. But there's still a lingering pricing in of one more potentially rate hike. It's less than a coin flip. It's probably like 30% last time I checked, baked into Fed fund futures that the Fed goes one more time, either December or sort of January, I guess, kind of time frame. But that is really consistent with what we've talked about, the Fed's kind of fighting retreat from the tightening cycle. They don't want to have like the mission accomplished banner. They don't want to do that. They want to keep everybody guessing, everybody on their toes. It helps them keep financial market conditions tamped down. And, and so we think that the communications have really gotten through. And the higher for longer message has been, obviously been part of the upside that we've seen, the uptrend in longer dated treasury yields, pricing in that higher for longer setting. But, still there are rate cuts that start appearing into in the outlook when you look further out in Fed fund futures by even as early as kind of like early summer next year. The idea that the Fed will be reversing some of its hikes is still very much in play.
Yeah, you bring up a good point, John. I mean, we've seen inflation start to moderate again. I mean, it's the lowest level of growth in about 2 years, a little over 2 years. And yet all of the signs that we see around the consumer and economic growth are coming in hotter than expected. So it feels to me like the evidence for the soft landing seems to be building despite the consistent worry that, we're still going to crash at the last few feet here. The GDP data was, super strong, third quarter up 4.9%. That beat expectations and certainly was, more than double the gain of the previous quarter. And a lot of that was really driven by the strength of the consumer in the face of higher interest rates, in the face of the headwinds of student loan repayments restarting, the headwinds of the global political tensions that we've been seeing. The consumers just remain resilient.
Personal income and spending. Income was up 0.3%, but spending in September was up 0.7%. And it was fairly broad-based. So, and the consumer still has a job. We talk like we're in recession and, like red full employment. And I mean, I think GDP was a little higher than normal, but I think that the reality is we're at a 2 to 3% GDP rate going forward, rather than the idea that we're falling into recession.
Yeah, absolutely. It sounded like the increase in GDP was driven by both the services sector as well as the goods sector. One thing that I kind of wondered about, though, is that, when you look down into the categories that drove spending in each of those different components, for the services sector, the categories that drove the spending was housing and utilities, right? So both of those, not necessarily the reason you want to see consumer spending increasing, right? We know that housing has been a real issue, and almost everyone's been waiting for sort of that drag from high housing costs to show up in the economy. Utilities, we've seen what's been going on with energy prices, et cetera. And then on the goods sector, what really drove consumer spending was the cost of prescription drugs. So I wonder how much of this is spending on necessities versus spending on all of those Taylor Swift concerts and paraphernalia.
Been a lot in the summer, but we've definitely transitioned into necessities in the fall.
Yeah, there's this undertone, and you can see it in sort of the non-traditional data that's coming out. It's credit card delinquencies, it's car payment delinquencies, these things showing, some fraying around the edges. There was a sense that this would probably bleed into some of the more mainstream retail sales numbers over the past couple of months. It really hasn't seemed to. But, as you say, the consumers are diverting. They're certainly in some of the socioeconomic strata, the stress is building, and you can see that with some of the guidance. So the credit card companies, we saw, Visa came out and we'll talk a little bit more about earnings, but this has been a pretty sober earnings season so far. We're only halfway through, but we have had a lot of the heavy hitters, and some of the messaging has been sobering, and so we're kind of seeing that in some of the stock reactions.
Yeah, so it's interesting because I believe that MasterCard came out and said that while they saw higher transaction volume, they weren't seeing maybe consumers spending on the same types of products that they were before. But Visa said that they're still not expecting a recession, even despite, again, all of the things that are weighing against the consumer and all the headwinds they're facing and all the times we've been waiting for the consumer to start to pare back. It seems like they're still going at least at a strong enough level to keep the economy churning without sort of driving us off that cliff.
And last night we got Capital One, who is a credit card company, not just a processor, and he said that their credit trends are normal for seasonality and they're kind of stabilizing. So, they're the biggest credit card company, one of the biggest credit card companies in America. So that's definitely a good sign for credit quality. But I think that while credit quality is not slowing, what you're seeing is the higher rates are starting to eat into some consumption. Like Harley Davidson had a very bad quarter. It's just more expensive to buy a motorcycle. And Harley's even offering discounts on the loan out of their own pocket. You're seeing the same with the home builders. A lot of home builders are buying back part of the buyer's mortgage. So, higher rates are starting to creep into purchasing, but it's not creeping into, you defaulting on your debt.
Okay, here's a thought bubble, perhaps. If we don't see rate cuts until maybe next summer at the earliest, and if, despite, again, all of the potential pessimism or a fear of a recession, the recession doesn't actually emerge until maybe mid-2024 or even after that, is it really part of the same cycle? Or is that, or could we say, can the Fed say, we engineered the soft landing? In fact, for a lot of 2023, we enjoyed declining, moderating inflation, relatively strong or very strong job market in some ways, economic growth writ large. Consumers still were pulling out their wallets, and so when we hit the next when we hit the recession, it's part of a different. You're resetting the clock. Is it really part of the same arc?
I think that's right in terms of growth, but the risk is that everything we went through, that inflation just becomes more sticky than we hope. And that forces the Fed to remain higher than they would have hoped for, which then can drive us into recession, because that's might be the only way to get recession to get the Fed's target inflation rate back down to that 2%, where maybe we get stuck in the 2.5% to 3% range.
Yeah, the kind of nightmare scenario is that the Fed has to go back into rate hike mode at some point next year because of, it's the stickiness of inflation is feeding, of energy prices or whatever is feeding back into core. The U.S. economy has proven, relatively resilient. And then the Fed decides that, maybe they haven't done enough. And some of the Fed speakers, we've sort of characterized this commentary as sort of empty threats. But it does represent at least for the moment, we think that's true. But it does represent a potential tail risk next year. We have seen, they saw in the 70s, you have these like successive waves of inflation, the sort of echo of inflation that seems to come back. Hopefully we miss all that. But we are in a world where the inflationary pressures, these structural inflationary pressures that we're seeing, whether it is, wherever you come down on the spectrum, the pendulum swinging back toward labor. Everybody saw the way the United Auto Workers are, pushing for higher pay. That tends to be inflationary. The reshoring dynamic from China tends to be inflationary. Just the geopolitical, the risk premium that's now built into oil, energy, and certain other commodities, that's tends to push prices up. And we've seen the dissatisfaction, even though the inflation rate has eased off, the dissatisfaction among consumers. John Dick has spoken about this a lot, that prices aren't where they used to be. They've maybe they've steadied, but you're not going back to the status quo ex ante.
That's an important point, because when we look at the data on a monthly basis, we focus on the month over month change, and that is kind of returning to normal levels where it was, usually rising 0.1 to 0.3%. But it went up 15% and it stayed there. So the cost, whether it's an apple, milk, or your car, that's still 15% higher than it was, basically a little over a year ago, and people are annoyed about it.
Yeah, I mean, it's almost this feeling of, I want my prices back, damn it. Right?
And also part of it, it's not just like the goods we buy, but because we had such cheap, money was free. So your ride sharing apps and things like that was all subsidized by Wall Street. That's why you could take an Uber for like $6. An Uber now is $30 because they have to turn a profit. So, we had a lot of things in the last, 5-6 years that were just way cheaper because the companies didn't have to make money because there was nothing else to invest in because rates were so low. Now you can buy a 10-year treasury and, get 5%, risk-free. Well, we hope it's risk-free depending on what's going on in DC. But so the whole kind of dynamics of running a business has changed. You have to be profitable, and thus you actually have to charge enough for that product to cover your expenses and turn a profit.
So I almost wonder which one is scarier. If we're going to continue telling our spooky stories from last week, which one is scarier? The Fed cutting rates because the economy is slowing down and we're heading into a recession, or the Fed returning to hiking rates because inflation is starting to spiral again, and that could also then lead us into a recession. Pick your poison here.
Yeah, I think we know that cutting rates works eventually. We're not exactly sure how much we have to hike to handle inflation. So I'd take cutting rates any day over having to raise rates.
Yeah, our expectation is that the Fed is going to be on hold. It's going to be in do no harm mode, with the challenging cross currents that we're seeing. It's essentially kind of a stagflationary environment in a lot of the world. We think that that's probably coming soon to a slower pace of growth in the United States, but with elevated prices, and that's not a great situation. And when the Fed is faced with not so terrific choices on and risks for tightening further and or loosening, we think that they're just going to sit on their hands. And this is particularly true given that this is going, the typical dynamic of the Fed in an election year is, you get your policy out of the way and you want to stay out of the spotlight as the campaign heats up. You certainly don't want to engineer a recession or have like a major, it's auspicious to have like major policy campaigns by the Fed around an election time frame. And it's not It's not a rule by any stretch of the imagination, but if they can avoid it, they probably will avoid it. And we think that that is going to be kind of another factor that keeps the Fed, very much on hold. They don't want a recession. They don't want a comeback of inflation. And the safest thing for them to do, I think, is to, just stay where they are.
They're in a difficult standpoint in terms of their credibility because of the election, where usually they would do exactly what John just said. But if they stay on hold and rates end up being too high and we go into recession, it's likely that Biden will lose and Donald Trump will win. But if Donald Trump wins, he's immediately going to get rid of Powell and institute, a very loose monetary policy, which will thus, question the Fed's credibility. So they kind of have a lot of circular reasoning in terms of how they have to play this one out. It's kind of one of the most unique scenarios, both in politics and monetary policy we've ever faced.
Yeah, Trump really wasn't shy about his commentary on the Fed. He's already started talking. We've talked about this in a previous podcast. He already talked about in an interview how rates are too high. Nobody can buy houses. Nobody can do anything. And, that is definitely going to be, it seems like, he's pretty consistent on that point. That was the way that he operated when he was in office. But boy, obviously the circumstances and the macro backdrop have changed dramatically since when he came to office in 2017.
And just to be clear, in terms of the Fed Reserve mandate, the president can replace the chair. He can't fire him. So Powell can stay on the FOMC, but he is allowed to replace him as chair. And obviously, if you get replaced by chair, you're probably going to leave and go do something else. So there is, legal precedent for him to get rid of Powell.
Yeah, I think Trump has referred to himself as a low interest rate guy before, right?
Yeah, he's also a debt guy. He's not about cutting fiscal spending.
Yeah. So in another one where, if you're worried about fiscal rectitude, the Democrat this time is probably the one you should vote for, not the Republican.
Well, I mean, it certainly is putting the Fed in a tough spot between the rock and the hard place. But it seems, at least for now, the Fed has done a pretty good job of convincing markets of its higher for longer story, its higher for longer approach, which the same thing may not be able to be said about the ECB, which just took a pause for the first time in 15 months.
Yeah, it's we think that the ECB's done like the Fed is done. And you can certainly look at the inflation data. The inflation data in the EU is, a little bit disparate, but it's it's going in the right direction. We've seen, one of the things is obviously it's base case dependent, and it's so much of its energy. You get really noisy economic data out of, Germany's producer price indexes are down like double digits, on an annualized basis because, we're comparing them against the time when you had spiking natural gas and energy prices and so forth. So it's a little bit hard to draw a bead exactly on where their inflation is, but it seems to be going in the right direction. Where at the same time, we had the purchasing managers indexes for October, the preliminary readings, which came out in the US, surprised to the upside. That was exactly the opposite of what happened in the EU. They surprised the downside. And we have consistent contraction. It's a much more difficult situation on the growth side. They are closer, geographically to the locus of some of these horrible events in the world. It's the Fed has a tough position, as we've said. The ECB probably has a tougher one. If you're looking for canaries in coal mines, looking at Italian bonds, they're okay for now, but that's where you're going to see that kind of stress, a sort of fiscally wayward government, some hints of stress building in the system. I think again the ECB is probably going to do a lot of talking to try to keep investors on their toes, but it's tough to see them finding a real directionality in policy here from where they are.
Yeah, Lagarde said that, not hiking now doesn't mean that they're not going to hike in the future. So she's still trying to keep the possibility of another increase on the table. But she was very clear in saying, any talk of rate cuts is premature at this point. So again, trying to give that flexibility to go up, but but trying to uh, send the message to investors that they're not going to be easing anytime soon. What does this mean for the dollar? I mean, we've obviously seen such a big rise in the greenback, over the course of the past. I've lost track of how long it's been going up, but certainly that has some implications not just for the developing world and the debt they hold, but also for trade in the U.S. and in our exports. I think we talked last time about Christmas in Japan as a
Right.
possibility here. But how do you see the role of the dollar playing out?
It really is, taking a step back and looking at where the dollar is. If you look at the dollar chart, right, it is up, close to really extreme levels. And yes, there are all these different ways to measure the dollar. And so it's, you can't always do an accurate sort of historical comparison, but by any metric, the dollar right now is really, really strong. That is it. When you look at other instances of dollar strength, I'm thinking about like the big spike in the dollar in the sort of 2014-15 timeframe. It caused all kinds of hazards and disasters in emerging markets. It pushed China to the edge. It was a global deflationary mess, and now there's intervention and mini devaluations. The renminbi had the mini devaluation in late 15. It was really a kind of a traumatic time. The dollar is is that kind of level of strength. And it just is, it's kind of cool, right? There's low volatility in the currency space. You're seeing, some efforts, obviously, by the Japanese officials to kind of stabilize the yen, but they're trying to keep it from getting too weak too fast, which tends to be a more relaxed kind of policy for them. They tend to be far more panicked about yen's strength. The renminbi has kind of leveled off here with the efforts of Beijing, but again, the weakest it's been since 2007. A lot of the other G10 currencies aren't at those extremes, but they're still very much on kind of historically weak footing against the dollar, but in a way that is kind of less disruptive than we've seen in the past. And some of it's just the ways in which strong dollar has manifested. Usually you would get these correlations like strong dollar would crush oil prices. Well, not this time. The oil, if you think oil is expensive in dollars, try it in yen, right? So these are, and some of the other the sort of global disinflationary dynamics when the dollar tends to be strong haven't really kicked in this time. So it's and you just certainly don't hear the Treasury Department, you don't hear Janet Yellen talking about the dollar and the idea that she would be talking down untoward dollar strength. It's not something that Treasury secretaries do a lot, but when they are at these extremes, it's certainly not unheard of to have some nuanced language about the dollar. I haven't heard much of anything about it. It's not the dog that didn't bark. It's very strong and it's following rates up. It's kind of been predictable and less volatility in the currency space in general. So something that's kind of remarkable and maybe speaks to this being, a new paradigm rather than an extreme.
And we've been talking so much about the consumer and their ongoing retail therapy, if you will. And the strong dollar is good for the consumer, right? I mean, their purchasing power is higher and they can buy more things.
Yeah, absolutely. And if now that's supposed to, obviously, if the dollar is that kind of strength, that's going to potentially feed into their countervailing forces that should be weighing on the dollar here. The sort of deficit, the twin deficits, and so on and so forth. But when you're in an uncertain world, the dollar still looks like a safe haven. But the currently, and U.S. markets are where people want to park their money. Although they probably parked them in big tech stocks, which had a lousy week because of earnings. But still, this is.
But over the course of the year, it's been a pretty good bet.
Yes.
So next week, we already talked about the FOMC meeting that's going to be happening. Looks like it's going to be a no drama decision to hold steady. It's what everyone's expecting. What else is on the radar screen for next week, Brendan?
We also have the Bank of England, and then in terms of the big data, we get the jobs report on Friday.
We'll see if it's as blockbuster as it was last time, or if there's any sort of cooling. Will be really interesting to see the revisions, and if the month of September is revised down at all, considering how much stronger it was than everyone had expected.
Exactly, and not even just September, but the previous months. But in terms of jobless claims, they're still running pretty strong. So there's not any expectations that we're going to fall off a cliff, but maybe we're not up above 300,000 like we were last month.
Well, the other big thing that's happening next week, of course, is Halloween. That's going on. So I looked up. We talked about this consumer again. I looked up how much consumers are expected to spend on Halloween this year. According to the NRF, Halloween spending is going to set a record of $12.2 billion. That's exceeding last year, which was also a record, at $10.6 billion. So lots of candy corn will be consumed over the next few days, not just in the Mui household, but all across America. Do you guys have your costumes and your candy ready?
The kids definitely do. I haven't thought about it yet.
Yeah, I usually go trick or treating with my daughters dressed up as my typical costume is lame suburban dad, where I have my Skechers on and a pair of khakis and a vest. Right. So
you got your dad jeans on.
Yes, that's my usual disguise. It's not a disguise. It's my identity.
You've got your number down. I was interested to see. So here, speaking of the most popular costumes, the most popular adult costume is a witch, kind of typical. The second most popular is a vampire, and the third most popular, clocking in at 1.8 million expected people to dress up as Barbie. So you could
yeah, that's a big one. Yeah.
Oh yeah.
You could be Ken. You could throw some Kenergy out there. See how it goes. But this one reason I brought that up, and I think it's so interesting, is because it does show sort of the long tail of the movie, right? But also of the impression it made on consumer psyche, and then how that feeds into consumer spending.
Yeah, and it's sort of like in the category of affordable fun, right? It's an experience that you don't have to like break the bank to enjoy, and like having going to Walmart and picking up some decorations and throwing them out in the front yard is it's not going to set you back too much, and it's a nice way to enjoy the season and get in the holiday, get in the spooky Halloween holiday mood.
Great. Well, I hope that everyone has fun carving their pumpkins this weekend. That's going to do it for us today. I'm Ylan with Penta. My co-hosts are Brendan and John from Markets Policy Partners. We hope that you enjoyed our show. And remember, you can always listen, like, and subscribe to the Macrocast wherever you get your podcasts. Thanks for listening.